Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of a comprehensive guide to private equity investments. Understanding the basics and future trends. Have you ever wondered how some investors seem to know exactly where to put their money? Private equity investments might just be the answer. These investments play a crucial role in shaping businesses and driving growth, often turning potential into profit. In this video, we'll break down what private equity is all about, why it matters in today's financial landscape, and who can benefit from understanding it. Whether you're a seasoned investor or just starting to explore your options, knowing the ins and outs of private equity can help you make smarter financial decisions. We'll tackle common misconceptions and show you the paths private equity can open for you. Get ready to learn how this powerful investment strategy can transform not only businesses but also your own financial future. Understanding private equity. Private equity investments offer a unique approach to growing wealth by focusing on private, non-public companies. Unlike stocks traded on major exchanges, private equity involves direct investment in companies that may not be as accessible to the average investor. This can create opportunities for substantial returns, but it comes with its own set of risks. What is private equity? At its core, private equity is capital that is not listed on a public exchange. Investors usually pool resources through funds managed by professional firms. These firms acquire significant stakes in private companies or take public companies private. The goal is to improve these companies, boost their value, and eventually sell them for a profit. Private equity can be seen as a long-term investment strategy that often involves changes in management, operations, and strategy to increase a company's overall value. This differs from other types of investments like public stocks, where shareholders have less control and influence over a company's operations. When venturing into private equity, it's essential to understand that investors typically commit their money for several years before seeing returns. Types of private equity. Private equity encompasses a variety of investment types, each catering to specific goals and risk levels. Here are the primary categories. Venture capital. This form of private equity focuses on startups and small businesses with high growth potential. Investors take on more risk here, often funding companies in their early stages. The idea is to support innovations that can lead to significant returns if the company succeeds. Growth equity. This involves investing in more mature companies looking to expand. Growth equity investors provide capital to help with product development, market expansion, or acquisitions. The companies are often already generating revenue, making this a less risky option than venture capital. Buyouts. Buyouts occur when a private equity firm purchases a controlling interest in a company, usually to restructure it for better profitability. This can involve taking public companies private. These investments usually require substantial capital but can lead to significant returns through operational improvements. Distressed investments. These investments focus on companies struggling financially. Investors buy into these companies at a lower price, aiming to turn them around. While this strategy can be high risk, it can also yield high rewards if the company recovers successfully. In summary, understanding private equity means recognizing the various types and their potential upsides and downsides. With the right strategies, investors can tap into the value hidden in private companies, but it's critical to assess each opportunity carefully. Which type of private equity might align with your investment goals? The private equity investment process. Understanding the private equity investment process can feel like navigating a maze. Each step is crucial and requires careful planning and execution. Let's break down the stages involved in this complex journey, from fundraising to exit strategies. Fundraising. Private equity firms rely on capital from investors to fund their activities. Think of this step as gathering resources before heading into battle. Here's how it typically works. Target investors. Firms reach out to various types of investors, including high net worth individuals, pension funds, insurance companies, and university endowments. Pitching the fund. A compelling pitch is made to attract these investors. This includes presenting a clear investment strategy, showcasing past successes, and discussing the team's expertise. Commitment. Once investors agree to participate, they commit a certain amount of capital over a specified period. This capital is often pooled together in a fund. Closing the fund. Once the target amount is raised, the fund is considered closed. From here, the firm can start acquiring and managing investments. Sourcing deals. Finding the right investment opportunities is like searching for hidden treasures. Private equity firms employ several methods to identify and evaluate potential deals. Networking. Building relationships is crucial. Firms often rely on their networks to gain insights into companies that may be for sale or in need of investment. Market research. They conduct extensive market analysis to spot trends and potential opportunities. Investment banks. These firms often partner with investment bankers, who help them find companies likely to be sold. Direct outreach. Sometimes, firms will directly approach companies that pique their interest, even if those companies are not actively seeking investment. Due diligence. Due diligence is the process of thoroughly investigating a potential investment. It's like a detective piecing together clues to avoid costly mistakes later on. Here's what it usually involves. Financial analysis. This includes reviewing financial statements, tax returns, and cash flow projections to understand the company's financial health. Operational review. Firms examine the company's operations and business model to identify strengths and weaknesses. Market position. Understanding the competitive landscape helps firms gauge the company's potential for growth. Legal review. This ensures that there are no legal hurdles or liabilities that could pose risks after the investment is made. Execution and management. Once a deal is finalized, the real work begins. Execution and management are critical to ensure that the investment flourishes. Here's how firms typically approach this stage. Strategic planning. Firms work with the management team of the portfolio company to develop a clear strategy for growth. Operational improvements. They often implement changes to improve efficiency, reduce costs, or expand into new markets. Monitoring performance. Regular assessments and improvements are key. Firms frequently check financial performance against expected outcomes. Support services. Many firms provide additional resources, including marketing and operational support to help portfolio companies succeed. Exit strategies. Exiting an investment is as important as entering one. Private equity firms must have a solid plan for how to sell their stakes and realize profits. Common exit strategies include initial public offering, IPO. This is when a portfolio company goes public, allowing the firm to sell shares on the stock market. Sale to a strategic buyer. Firms may sell the company to another firm that sees strategic value in the acquisition. Recapitalization. This involves restructuring the company's debt and equity to provide a return to investors while maintaining ownership. Secondary buyout. In this case, a private equity firm sells a portfolio company to another private equity firm, allowing for continued growth under new management. The private equity investment process is a multi-step journey that requires keen insights, strategic planning, and precise execution. Each stage plays a pivotal role in ensuring the investment not only flourishes but also delivers returns to investors. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.